So module 4 is the reason why I chose to study this subject, derivatives. Firstly, we're going to look at the role of derivatives in the financial risk management. There's this term called black swan events, that is when it's unknown. So there are some things called known unknown. So you know that something's going to happen, but you don't know when it's going to happen. But in black swan case, is you don't know when it's going to happen, but you don't know what's going to happen as well. You don't know what you don't know. That's black swan event. There are three main categories of derivatives: real derivative or real options, commercial options or synthetic derivatives, and lastly financial derivatives. For real options or real derivatives, that is the right but not the obligation to vary an investment or contract, or to opt out of a proposed scheme or project. There are three types of options in real options. First is timing options. This determines when an investment is undertaken. Exit options is to abandon a project. Operating options, this is to adjust operations during times of strong or weak demand. For commercial options or synthetic derivative, this is a right to adjust the terms and conditions of commercial contract. For example, repricing clause, warranties, ceiling or floor price arrangements, inflation or CPI adjustments, or on-costing. Lastly, financial derivatives. There are two types of platforms you can trade this on. Exchange trades, it is more standardized type of platform, whereas over the counter, that is a tailored type of platform. On exchange traded platform, you can trade futures and options, whereas on over the counter, there's forwards, swaps, and options that can be traded. So for futures and forwards, this obliges the buyer to buy an asset at agreed price at an agreed future date, or it obliges the seller to sell. For swaps, this requires two parties to exchange cash flows from one asset for cash flow from another asset. For options, this gives the option buyer the right, but not the obligations, to buy or sell an asset at an agreed price at or before an agreed future date. So, what is earnings at risk? This is to do with cash flow estimates, so this is a P&L. It is a quantity by which net income is estimated to change in the event of an adverse change in currency or interest rates. For example, yearly earnings of $1 million and earnings at risk of $250,000. The expectation of this is earnings in the first year time horizon is 1.25 million or 750,000. That means you are likely to gain 250,000 or lose 250,000. When it comes to value at risk, this is more to do with stock estimates, so it's in the balance sheet. This is the changes in the entire value, usually fair value, of an investment or derivative portfolio with its consequent risk of loss. So the probability of the size of a future financial loss. Example of this would be 1 day 2% value at risk of 1 million. This will lead to 2% probability that the portfolio will fall in value by more than 1 million over the 24-hour period if there is no trading carried out. So expectation is loss of 1 million or more in 1 day out of 50 days. So 2% probability. So breaking this down, so there's a 2% chance of 1 million falling in 24 hours. So you're likely to lose 1 million or more in 1 day out of 50 days, because 1 divided by 2% is 50. What is basis risk? So basis risk is associated with imperfect hedging when using derivatives. So this would be spot price of hedging asset minus price of hedging instrument. So the difference between the value of the asset whose current price is being hedged and the price of asset of the underlying derivative. There are fewer basis risks. So locational or geographical basis risk, which is the mismatch between the delivery locations of the underlying derivative and the derivative's settlement location. For example, Australian retail oil prices versus the closest related future price for oil in Singapore. There's product basis risk, which is when an asset or commodity price risk position is hedged with futures or derivative of similar but different products. So for example, corporate bond versus government bond futures contract. Lastly, calendar basis risk. That is when assets are hedged with future contracts that deliver to different dates. For example, a result of a mismatch between the maturity date of derivative used and the actual selling or delivery date of the asset being hedged. So the key concepts and definitions of derivative that we should consider would be spot price, which is the value of the asset or benchmark on the day of the transaction. Value date, which is the date on which the cash or other means of payment is transferred. And forward date is the future date on which forward purchases and sales are settled. Now we're gonna look at those full financial derivatives. Firstly, futures. In contrast to the forward contract, for futures, you do not need a line of credit, but both the buyer and seller have to maintain a margin account. There's this movie called Margin Calls. That is when you don't have enough fund in your account. You need to maintain a certain level of cash in your margin account in order for the transaction can be made. So there's this term called novation. This is the clearing house that interposes itself as a counterparty to each trade and guarantees that the trade will be settled as originally intended. There's initial margin, that is the collateral deposited by the future buyer or seller to the clearinghouse to cover possible future losses in the position over a short day. Variation or mark-to-market margin is a margin based on a daily changes in the value of the contract. So the opposite to this would be forward contracts. So within the trading process, there are three types of risks. Credit risk, since there's no margin or premium payment between the two parties. There's also market liquidity risk because you cannot sell the contract to a third party. Another risk is settlement risk in case one party defaults on the settlement of the payment. However, this is typically managed through offsetting cash flows on a net basis between two parties. So interest rate forwards, the difference between the agreed rate and the current rate at the future date is settled in cash at the start of the reference period. Forward rate agreement is when one party agrees to pay a fixed rate for a defined term with the term to commence at an agreed future date. So for example, a borrower agrees to pay a fixed rate of 5% on $1 million using a 6-month versus 9-month FRA, forward rate agreement. This means that the contract has secured the 5% interest rate for 3 months borrowing period because the contract will start in 6 months and it will end in 9 months, stating that the reference period would be 3 months. So it is also assuming that 6 months after the FRA is entered into, the differential between the agreed rate and the market rate will be cash settled. If the interest rate in 6 months' time is 6%, then the borrower will receive $1 million times 6% minus 5%, because 5% was the initial secured rate, times 90 divided by 365. So 3 months is 90 days, and there's 365 days in Australia. So 90 divided by 365. If the agreed rate, so 5%, is higher than the market rate, for instance 4%, then the borrower will pay $1 million and then multiply that by 5% minus 4.5% times 90 divided by 365. So that is how you calculate for rate agreements. Also, when it comes to forward contract, there's this term called Contango and backwardation. This relates to commodity forward markets, which we'll discuss when we talk about commodity in module 6. But essentially, Contango is when the forward price is higher than the spot price. So the price will go up as the forward rate is higher than the spot rate. Spot rate is now, price now. So it is normal for a non-perishable commodity that has a cost of carry, for example, warehousing fees, interest foregone, or lease fees. Any commodity that has that kind of feature, then it is normal for the forward price to be higher. Whereas for backwardation, that's when spot price is higher, so price now is higher than the price in the future. This would be caused by temporary supply disruptions or increase in demand, or natural disasters, or forecasted market surplus. So we're gonna compare between futures and forwards. So for futures, it has daily mark-to-market and settlement with clearinghouse. It is regulated through futures exchange. It has high liquidity enhanced by standardization and centralized exchange and margining. It is closed out by offsetting or reversing trade. It is closed out prior to delivery in over 95% cases. It has limited or standardized number of settlement dates. Whereas for forward contract, it is settled at maturity. It is self-regulating but with government supervision. It has lower liquidity but contracts readily neutralized by taking offsetting contracts. It closes it out by negotiation, and the delivery or settlement usually takes place, and any date is possible for specifying settlement. The main difference, I guess, in here is the platform that they're used and also the risk that's associated with the contracts. Another type of financial derivative is swap. Most cases they use interest rate swap. This is an agreement between two parties to exchange cash on a notional principal sum that is not exchanged. So if you want to protect against interest rate rising, then you will want to pay a fixed rate on an interest rate swap or receive a variable rate. So if you think that interest rate's gonna raise, then since you're gonna be paying, you want to stop it from rising, so you want to hedge on the price that's already set so that you don't have to pay more when it's increased. So you want to pay a fixed rate. But if you want to protect against interest falling, then you will want to receive a fixed rate on an IRS and pay a variable rate. You don't need deposits in order to trade interest rate swap, but the bank would need to have a credit limit in place for the organization before any transaction can take place. For options, there are a lot of ways that options can be used. Options written on physical commodities can be used to manage commodity price risk. Options on interest rate swaps or swaption can be used to manage interest rate risk. Options on interest rates, it can be used to manage interest rate risk arising from floating rate interest exposure or future borrowing and lending programs. So there's difference between interest rate swap options, so swaptions, and interest rate options. And also there's options on foreign exchange, so it can be used to manage forex risk. If you look at the option matrix, if you're a buyer of an option, then you need to pay premiums. If you're a seller of an option, then you will be receiving premium. With call options, you have the right but not the obligations to buy. When you are a buyer of put options, then you have the right but not the obligations to sell. When you're a seller of call option, you have the obligation but not the right to sell. If you're a seller of put option, then you have the obligation but not the right to buy. So when you're determining the price of basic or vanilla options, there are a few elements that you gotta consider. First, you gotta consider the underlying spot price, then strike price, which is the intrinsic value. So when call option is in the money, that is when the forward price is higher than the strike price. When put option is in the money, then the forward price is less than the strike price. Time to expiry or time value reflects the likelihood that the option value increases before the expiration due to the favorable move in the underlying securities price. There are two styles of options. American style option can be exercised at any point in its life until expiry, whereas European style option can only be exercised at expiry or maturity. There's two types of volatility: historical volatility, which is the actual volatility, and implied or future volatility. And also there's domestic and foreign interest rates when it comes to determining the price of the basic options. So strike price, you can also call it agreed price or exercise price. So we looked at forwards, futures, swaps, and options. There's also another type of derivative called exotic derivatives. There's something called knockout trigger. This causes the derivative to cease to exist if a predetermined price level is reached. There's another thing called knock-in trigger. This causes the derivative to only exist when a predetermined price is reached. And compound derivative is an option on an option. There are a lot of scenarios that we can use different hedging solutions for. For example, if you want to protect a price from further falls, then you will want to use floor option. Or for example, when revenues are at risk, you will want to use floor option. Or when the cost is the issue, then you will want to use ceiling option. If you're in a situation where if you just want crisis protection only, then you will want to use out of the money option. This is only triggered at a value a considerable distance from the current price level. If you want something that's even cheaper than crisis protection only, then you would want to use knockout option, which I have discussed before. So knockout trigger. This causes the derivative to cease to exist if a predetermined level is reached. The option is terminated should prices move in the opposite direction beyond the specified level. If you want to benefit from falls, then you might want to use reverse floater. And if you want a benefit from further rises, then you would want to use leverage floater. So there are so many types of hedging equipment that you can use in order to solve against any potential issues that you may have. Lastly, we would discuss the credit value adjustment, CVA. This is a market estimate of a measurement of counterparty credit risk. So the difference between the risk-free and risky value of the transaction and the expected loss arising from a counterparty default. So CVA is the discounted expected exposure times default probability times loss given default. So that was module 4. This went pretty fast. This gave us a brief overview of derivatives. So 3 derivatives, which was real derivative, commercial options, and financial derivative. Yeah, so we're gonna look at module 5, which is the interest rate risk management.